Hi, how's it going everyone? My name is Henk and welcome back to the channel. In this video, we'll be taking a look at the basics of option trading. Now we're going to look at what is an option when it comes to trading, why you would want to use options instead of just buying shares, and where to go to if you want to buy and sell options. So what exactly are options? Now, options are contracts that allow the option holder to buy or sell a security at a certain price within a specific time period. Now, the security may be a company share, an ETF, an index, or a commodity like gold or oil. But in order to do that, the option buyer has to pay a price to the option seller called a premium. Now, the option buyer then has the right, but not the obligation, to buy or sell the particular security at that price. Now, if the share price does not go the way that the option buyer wants, they can let the option expire, but in that case, they will lose the premium. Now, this might all quickly sound a bit confusing. So, analogy that some people use for describing options is like when you put in a down payment when you want to buy a house. So, when you are buying a house, you first put in a down payment of maybe around 20%, and then you can purchase the house at an agreed price. If you change your mind and don't want to buy the house anymore before the house settlement date, you lose your down payment. Option allows you to buy or sell at a particular price called the strike price by paying a premium. There are two main types of options, which includes the call option and the put option. In general, when you buy a call option, you want the price to go up. Now, when you buy a put option, you want the price to go down. Think of it as if you are calling someone. You raise your hand, so your hand goes up. So you want the price to go up. So when you have a call option, you want the price to go up as well. On the other hand, if you are putting something down, you are lowering your hand, you want the price to go down. So when you have a put option, you want the price to go down. There are three main parts to each option contract: the strike price, the expiry date, and the premium, which is also the cost. Now, each option contract allows you to control 100 shares. So a call option allows the buyer the right to buy 100 shares at a particular strike price at a specific date. But why would you want to use options? Why not just buy shares on its own? Now, the reason is that options provide leverage. As mentioned before, each option contract allows you to control 100 shares, so any gains are amplified at the risk of paying a premium. Let's take a look at an actual example on the computer. The first example that we're going to look at is the example of buying shares. So let's say you have $1,000 available in your account. So let's say hypothetically Apple shares cost $100 per share. So you bought 10 Apple shares at $100 each. And after a certain period of time, the Apple shares increased by 10% to $110. So this gives your portfolio $1,100 worth in total. The gain can be calculated by subtracting $1,100 from the initial $1,000 account, which gives you a gain of $100. If we divide the $100 by the initial amount that we started with, we end up with a 10% gain. So this is the first example if you buy shares. The second example that we're going to look at is if you decide to buy call options instead. So we start off with the same $1,000 initial starting amount. Let's say we're buying Apple calls with a strike price of $100 at $5 for a premium. Because with each contract you are controlling 100 shares, so we need to multiply the $5 by 100, which means that each contract will cost $500. So with our $1,000 starting amount, we can buy 2 contracts. Let's say the Apple share price increased by 10% to $110. So the total value that you would get back after selling the call option would be $110 minus $100 multiplied by the 200 shares, which you can control with your contract, will give you a total of $2,000. The gain will be $2,000 minus the initial $1,000 that you started off with, which is equal to $1,000. If we divide 1,000 by the $1,000 that you start with, you end up with 100% gain. This is significantly more than a 10% return that you would get from simply just buying shares itself. Now let's look at this in terms of a graph. This is a very important graph that shows you the profit and losses if you buy a call option at the strike price of $100. So our strike price is $100 and our break-even point is the strike price plus the premium that we paid for the call option. So we don't exactly break even when we reach the strike price because we're paying a premium. Now, if the price of the share goes above this break-even point, we will be in the profit. However, if the price does not go above the $105 break-even point, we will be at a loss. If we don't reach the strike price before the end of our expiry date, we will lose all of our premium. So in this situation, you will try to sell your call option before it reaches its expiry date so you can recoup some of the losses. The benefits of buying a call option is that your profits are theoretically unlimited depending on how high the stock price goes. And you are capping your losses because you can never lose more than your premium. Next up, we're going to take a look at put options. So for buying a put option, it works exactly the opposite way as when you buy a call option. Let's say you have the same $1,000 starting portfolio. Let's say we're buying a Facebook put option with a strike price at $300 with a $10 premium. So each contract allows you to control 100 shares. So each contract in this situation will be worth $1,000. So you have $1,000 starting and it's enough to buy one contract. And let's say our hypothetical example that Facebook stock decreased to $280. The total value of your portfolio after selling the put option would be $300 minus $280 times the 100 shares that you control, which would be a total of $2,000. Now, your gain in this situation would be $2,000 minus the $1,000 that you started off with, which is equal to $1,000. And this gives you also a 100% gain. If we take a look at the graph of buying a put option, it's the reverse of buying a call option. So when you buy a put option, for example, Facebook at a strike price of $300 in our situation, we have a strike price of $300. And then we have a break-even point, which is the strike price minus the cost of the premium, which is $290. If the share price goes below the break-even point, you'll be in profit. However, if the share price stays above the break-even point, you'll be at a loss. Now, when buying put option, both your profits and losses are capped. So your profit is capped because the share price cannot go below zero. But the good thing is that you can also never lose more than the premium that you paid for buying the put option. The best thing is that you don't have to worry about drawing these graphs for buying calls or put options because the brokerage app will do the graph for you. So where do you go if you want to purchase options? Now, one of the easiest ways to purchase options is with this video sponsor, Tiger Brokers. Now, with Tiger Brokers, you can trade in markets from 5 different countries, including US and Australia. Now, use my link in the description below where you can sign up and receive some free credits. Let's take a look at an example of buying a call option on the Tiger Broker app on the phone. Here in the Tiger Broker app, let's say we want to buy call options for Apple. So we can go to the stock itself, and then we look up the option menu near the top. So there are 3 buttons towards the top here, which you have all, call, and put options. So let's say I want to buy call options for Apple. I select call. So the next thing that you want to look at is the expiry date. So you can scroll through the different expiry date. Now, one thing to note is that the date format goes by year, month, and then date last. So for example, this particular expiry date will be the year 2021, and it's April, and it's 23rd. So just keep in mind of that. So we can scroll down the list to find the strike price that we want and the premium that it costs for that particular strike price. So let's say I think Apple stock price is going to go up, and I want to buy a call option for Apple at $130. So I can go to the $130 Apple call option. And here, if we scroll down, we can see more information on the price of this call option. So if I want to buy the option, I can click buy towards the bottom. And then I have to select the quantity that I want, which is close to the middle part. So I can buy two lots of option. So each lot of option allows you to control 100 shares. So the total cost would be $148. Now we can also expand this to see the break-even chart. So in order for our trade to break even, our break-even point is $131.48. And that includes the premium that we're paying to buy the option. We can see our max profit is theoretically unlimited, and our max loss is $148. And then we could place our buy order for this particular option. If you want to purchase a put option, it's pretty much exactly the same process. We go to the put option menu. So this case, if we think that the Apple shares is going to go down, I can select a strike price of $120. And I'd say I want to buy a put option. And then I enter the quantity of the put option that I want to buy. Here I can also expand and see the chart. And this tells me that my break-even point is $118.79. And my max profit is this amount, which is determined. And my max loss is $121. Now let's look at some of the very, very basics in options trading strategy. So I won't go into detail with any of these, and this is just to help beginners get started. Now, first of all, you want to determine whether you think the price of a particular stock or commodity will go up or down. And this allows you to decide whether you would want to buy a call or a put option. Secondly, you want to decide on the time period of the expiry date that you want to choose. Again, there's many different strategies to this, which will not be covered in this particular video. Thirdly, we want to buy options with lower implied volatility. So if we go back to our Apple option chain, we can see that we have our strike price for Apple, but if we scroll to the right, and we keep going, there'll be a column that says IV. Ideally, you want to look for options that has a low IV, because the lower the IV, the less cost in a premium that you would have to pay. If I go back and look at a company like GameStop, and I'll look at their option chain, I can scroll across and see their implied volatility. Whereas with Apple, I have an implied volatility of around 30%. GameStop options have an implied volatility of over 300%. This means I need to pay quite a large sum in terms of premium to buy GameStop options. So as a general rule, you want to buy options with low implied volatility and then sell when there's higher implied volatility. And all volatility can be affected by many different things, including earnings report, general sentiment, Reddit, and all sorts of other things. Last but not least, do realize that option trading is risky, and remember not to invest what you cannot afford to lose. If you haven't already, you should check out my full breakdown of Tiger Brokers, and I will see you in the next video.